In this video, we're going to continue with our discussion of Unit 4 Insurance on Wealth Management, and we're going to look at the types of life insurance policies that exist in the markets, right? These are the broad types that we're going to cover. We're not going to look at obviously every policy that is there in the market, but we'll try and bucket these policies into a few groups and understand what kind of advantages or disadvantages they might have, what kind of charges they might bring to the table, what are the most popular ones in those, right? So that's what we're going to look at. What are the key types of life insurance? Now, when someone is buying a life insurance, there is a decision point that you have to make. The first decision point is, do you want pure risk cover or risk cover plus investment income? Correct? That's your first decision point. The second decision point, assuming you want risk cover plus investment income, is do you want equity, you want debt, or do you want both? Correct? So basically, the flow chart, if I can call it, is like if you want a pure risk cover, that becomes one kind of insurance policy. That's called a term plan. If you don't want that, you want some investment income, then depending on what you want to do, if you want pure debt, then you get into something called as an endowment policy, or what is also called as traditional plans, right? If you want equity, you get into what is called as a unit linked plan, which also gives you the opportunity to use both equity and debt, right? Now we look at how these work. We look at how these create, but it is obvious that the investment income that you're going to get is going to come from your money. It's not like the company is going to pay it, right? So obviously, if you're taking a pure risk cover, the premium in the case of a pure cover is going to be far lesser than the premium that you will get in the case of cover plus investment. That's logical because your investment value is going to come from your money. It's not like the company is going to pay it, right? That defines the types of life insurance policies into these areas, where you have something called as a term plan, which is the pure risk cover that comes to you. You have endowment and whole life, which are kind of traditional plans investing in debt markets. And you have unit linked plans, which are basically called as ULIPs, which will give you an exposure to equity or debt, right? So we will look at individual characteristics of these now and understand which ones are the more popular ones. Historically, endowment whole life kind of policies have been extremely popular. In the last few years, unit linked plans and term plans have become more popular. Obviously, with the popularity of stock markets on the increase, people want some sort of an equity exposure when you look at the types of life insurance that come to you. Correct? So that's where this comes in and works well. Let's understand each one of them now. So we look at the term plan first. Here, this is a pure risk cover. This will have the least premium. There is only risk cover. There is no return, right? So for example, for someone with an age of 35, if you're looking at an insurance cover of about 50 lakhs, sum assured, without any history of ailment or anything, your premium would typically be anywhere between 6 to 8,000 per year for a 15 to 20 year policy. These are approximate numbers that we are looking at. So you just pay 6 to 8,000 every year and you get a protection worth 50 lakhs, right? So it's very cheap in that context that you have the least premium. So this policy is extremely cheap. There is no return that you are going to get of your money. So this is in a way like your vehicle insurance. You don't get the money back. You only get the benefit if something goes wrong, right? And if you do this at the age of 40, the premiums will be higher. 45, premiums will be even higher. So premium increases with age because risk increases with age. Now that's an important point, is because risk increases with age, it makes sense to buy insurance earlier. Which means when someone is young, when someone is 25 to 30 years old, it makes sense for them to buy a longer insurance there itself rather than waiting till they turn 40 and then they buy insurance, because it will become expensive. For the same kind of characteristics, it will become expensive because the risk of death goes up with age. As age increases, the general probability that a person will require insurance keeps increasing, right? So logically, the premiums keep increasing in that context. It's a very simple probability-based calculation that companies do. This is the cheapest form of insurance, and at some point of time, we'll explain you that this is also what is probably the best form of insurance. With all the other investment products available, insurance should ideally be looked at only as a pure risk cover instrument. And if we go for a term plan, that leaves a lot of extra money in our hand, which allows us to invest elsewhere. We don't need to cover our investment needs using insurance, right? Examples would be HDFC Click to Protect, Reliance Term Plan. You can basically buy a lot of these term insurance plans. They're available on all sorts of, obviously on all insurance providers. They're also available on some of the websites where practically you will have comparison of insurance products happening. Historically, because it's a cheap product or inexpensive product, there are less commissions that an agent would get in between, right? So if I am a distributor of insurance products, even though it might be best for my client, I wouldn't give it because I would get a very low commission out of that 6 to 8,000 per year. So historically, the incidence of term insurance has been less. Now it's increasing with awareness, right? So where has the incidence been higher? You will have endowment plans where you will have everything else now is insurance plus investment. So examples would be LIC's new endowment plan, ICICI Pru Savings Suraksha. These are risk cover with savings feature, typically debt-oriented investments that you're going to get. You could have a level premium plan where premium remains same throughout the tenure. You pay the same amount of money through the tenure. They can be participatory or non-participatory. And one of the kinds of endowment plans is what is called as money back. Money back returns, X% of sum assured at maturity, or it could keep returning money at specific intervals. You could have all kinds of permutations and combinations with policies, but in very simple terms, your endowment plans are going to take higher premium and put some part of that premium as risk cover and put the remaining part of the premium as investment in safe instruments, right? Now, historically, endowment plans at the end of the tenure will give you anywhere between 3 to 5% returns approximately, give or take a few percentage points here or there. So obviously they're not very great investment products because your bank FD would give you much higher than that, even on a post-tax basis. However, it kind of embeds the saving within that. So for people who are not disciplined, you might just do one shot of payment every year, and investment the saving plus insurance is taken care in one shot, right? But in itself, it may not be a very great product in terms of when you look at the investment angle to it or the savings angle to it. There could be better products available, right? In this case, obviously the premium will be much higher. You can pay probably 1 lakh a month, a year to get the same cover of 50 lakhs, right? So effectively, like we saw earlier. So out of this 1 lakh, about 8,000 will go in terms of the risk cover, and the remaining 92,000 will get invested, right? In this case, commissions are higher, right? And hence endowment policies have been very famous. LIC policies, a lot of them have been endowment policies. Then you have a type of endowment which is typically available for whole life, right? So far, we have a policy term that we have seen. There are some policies which work for whole life, which is till age. Some of them continue till 99 years, and those kind of terms come in. These are examples are ICICI Approved Whole Life Plan, BSLI, Birla Sun Life Insurance, Wealth Secure. Level premium plan, premium remains same throughout the tenure, usually non-participatory because the lifespan is covered till the end of life. It's for the entire life. Premiums, however, need to be paid only for a specified duration. So for example, if the age is 35, you may pay premiums for 20 years and then still get the cover for your entire life, right? You can get the cover here as well. Obviously, from premiums, you're going to now have three parts. One is the risk cover for tenure, one is the investment return in case there is something there, and the third is essentially whole life. In some cases, you could remove the investment return and just say that the cover is there for the whole life, and hence, for that we've charged the extra premium. So, whole life policies, in our opinion, don't make too much sense for a lot of people because we have seen that insurance needs go up and then go down. So what's the point of covering yourself at the same level all throughout your life? If this is the age span, 25 to 45 to 65, uh, there's no real benefit in having you covered at the same level all through your life. That doesn't make sense as long as someone has a stable income, right? So whole life policies, while appeal a lot because they're kind of giving the cover for a longer period, aren't really useful for everyone that is there, right? But they exist in the market, and these are the kinds of whole life policies. We next come to what is called as the unit link plan, which is the most common one sold these days, or what people desire is because this also gives you investment plus risk cover. This allows you to invest in equity markets, right? So it's like a fund, it's like a mutual fund that we've seen, kind of a mutual fund. Now, it allows you to invest in equity and debt markets, and most of the ULIPs can switch between equity and debt, right? So you can choose to put 100% in equity, and then if you think stock markets have gone up, you can switch that to debt. And then if you think stock markets have fallen again, you can switch all the amount again to equity. That switch is allowed at no additional cost. There are no charges to this switch. So that's one of the big advantages of ULIPs, that basically you will get the switching possibility without any additional charges that are there, and that's a huge advantage. Usually premiums are more hefty because of the switching facility that is available, because it's a longer term product. Lock-in period is 5 years. There are lots of charges that get associated with this. Usually ULIPs are fairly straightforward in the sense that they demonstrate a lot of these charges very clearly, right? There are 4 or 5 kinds of costs that are there. One is premium allocation charge, fund management charge because someone is going to invest that money in a fund. There is a mortality charge or mortality rate, and there is a policy administration charge, right? Premium allocation charge is when you pay the premium, typically your commissions go out of the premium allocation charge. Fund management charge is paid to the fund manager as such, right? Because someone is investing time and effort to manage that money. Mortality rate is basically the rate or charge that will be charged depending on the probability of loss for the firm. Remember. Now, the firm's loss can come due to two problems. One is the amount that you have paid so far is less. The second is age. So if age is up, mortality charges are up. If the policy term of the policy is new, mortality charges are higher. As you keep maturing in the policy, let's say I start the policy at the age of 35 and I keep paying my premiums till the age of 45, I've already paid a lot of the money to the insurance firm, right? So they have basically covered the risk to an extent. Mortality charges will keep going down year on year. Correct? They have a formula sheet for this. Typically, firms give you that formula sheet if you ask for them. And then there is a policy administration charge, which is a small charge that comes because you are running the policy, right? Let's look at a few calculations here. Examples of ULIPs where all these charges are demonstrated. So we take the example of two policies. One is the HDFC Pro Flexi and ICICI Elite Wealth, and we're just taking broad examples. These may or may not be exactly the correct numbers. We just taken numbers to show how the charges work, right? So with no offense to the policies at this point of time, typically premium is paid for a certain period. Let's say you're paying 5 lakhs for 5 years. Initial years, the premium allocation charges will be bigger because you're paying the premium. Honestly, this is where the commissions are paid out of. So that's where the charges are coming. Fund management charges are 1.35% each year. Policy administration charges only come up after the first 5 years. Once the policy comes into the being is where the policy admin charges will come. Mortality charges, typically there's a formula called age parity into sum at risk by 1,000. So practically if you have paid all your premiums, then sum at risk becomes 0. At this point, your mortality charges will typically turn out to 0 till the end. They also keep reducing here. We have just taken a simple individual number as a focus. So total expenses basically are the sum of these 4 expenses that you see for any kind of policy. We have just taken an example mortality charge here. This could be higher or lower depending on what the company's terms are or what the policy's terms are at that point, right? Now, there's another one called ICICI Elite Wealth, and again in this you will see that mortality will be 0% beyond your payment of all the premiums. It'll keep reducing as you keep paying premiums because you would have saved some money. There is a policy administration charge initially. There's a loyalty addition that comes here. So there are a lot of things that keep coming into the policy. You will note that the way it works is you add all these and then you subtract the loyalty addition. So if you have stayed for 5 years, then every year you get a benefit of 0.4 to 0.6% on the total costs. Similarly, there is also sometimes something called as a wealth booster. You will see here where 1% of your total cost is returned to you in the sense. So you'll see cost in those years will be lesser. Correct? In addition, you will have standard premium allocation charges and fund management charges. Typically, remember, your fund management charge is 1.35% of 5 lakh in the first year, but in the second year, 1.35% is on 10 lakhs. In the third year, 1.35% is on 15 lakhs. In the fourth year, you've paid 20 lakhs. In the fifth year, you've paid all 25 lakhs and the 1.35% is on that, right? So those are some broad examples of how you would look at ULIPs and ULIP calculations. You will typically have all these 4 charges which create it as a slightly inefficient product at this point. It's a slightly inefficient product because of all the charges. In general, when you look at investment plus risk cover both, the investment component is costlier than mutual funds, right? It's meant for someone who wants to kind of take both calls in one shot. But if someone is savvy or someone has an advisor, and we are all studying to become wealth advisors, let's say, then in that case, as a wealth advisor, it is your role to probably go and say that a term plan plus mutual fund may be a substitute to a ULIP. Correct. What is a ULIP doing? ULIP is giving you risk cover and investment in equity markets. Term plan is giving you risk cover and mutual funds are giving you investment in equity markets. You can compare these two on costs. We will do that at a later point of time to gauge which is better. Those are the broad types of life insurance policies which are available. At this stage, this level of understanding is enough for us. Let's also understand something called as riders to life insurance. Now, riders are additional benefits that you want at small costs. So for example, we saw that our policy premium is, let's say, 8,000, right? We can add a few riders by taking that to 8,900, for example, argument's sake. So this extra 900 that we are paying This extra 900 is going to give me a few riders. What are these riders? Let's understand the importance of these riders. Riders could be on critical illness, they could be on accident. These are add-ons to the basic insurance policy to supplement the insurance cover provided, right? So for example, there could be something like double sum assured rider. If your sum assured is 50 lakhs, by paying this extra amount, you could get the sum assured to 1 crore, twice the amount insured in case the death happens due to specific reasons such as accidental death. So accidental death benefit rider will allow you to increase the premium twice because of this extra premium that you're paying at a small cost, right? So that's double sum assured rider. Then you could have a waiver of premium rider as well, which is triggered if there is a disability or loss of income that makes it difficult to pay the premium. In case there is an accident which results in permanent disability for the policy holder and you lose your job and you're not able to pay the premium, there is a possibility that you could have what is called as waiver of premium rider. At a small cost, you could get this facility that in case something goes wrong, you may not need to pay the premium but still enjoy the policy cover, right? So that's one of the other riders. Accident or disability rider, which enables the insured to receive a periodic payment, essentially a periodic payout if someone is temporarily disabled or for a specific period of time. Sometimes people have an accident and let's say one arm is stuck for 6 months because of a fracture or something. So for that specific period of time, you could get a small payout if there is a temporary disability. This is again a rider. Riders come at small costs. You can add them to existing policy, right? That's the benefit of the riders. Instead of taking an entire policy covering that entire thing, it might be useful for critical illness. For example, it might make sense if you already have a life insurance policy to add the critical illness rider rather than going and taking another medical insurance policy with that particular illness covered, right? So sometimes for critical illnesses, you get the benefit coming out of that as well, right? So that's where the riders to life insurance will help us. That's it in this particular section. Couple of quick questions. Explain what do we mean by riders with an example, and explain briefly the major charges that apply to a unit linked plan. Thank you.